U.S. affordability now takes 34% of income. Just a few years ago, less than 25%. The jump from 3% to near 7% mortgage rates changed everything, and it should change how we think about home buying. This is Skylar Olson, prop tech economist and course creator of Real Estate Evolution and Disruption at the University of Washington, and you're watching In Data She Drops, where we connect what's happening in the market to your big decisions. News headlines predict the Federal Reserve will drop rates this year despite tariff concerns, but that won't impact mortgage rates and affordability as much as you think. Most sources predict mortgage rates will still end 2026 above 6%. And historically, that's normal. National affordability is then only expected to improve to 31% over the next 12 months, and that's with an incredibly optimistic 6% mortgage rate. So waiting isn't a game-changing answer. For dramatic affordability improvement, you have three main options: live smaller or double up, move away, or avoid a mortgage altogether using co-investment. Let's talk about the one that could really pay off. Buy somewhere else. I know it's not easy to create roots in a new place. My parents, my husband's family are all in California, where affordability hit the limit even when we were launching into adulthood over a decade ago. So we left. Today, the typical California household couldn't even qualify for a mortgage with 20% down. The monthly payment on the typical home gobbles up almost 2/3 of median household income. Our family set roots in Seattle, buying our first home over a decade ago before prices and rates shot up. Today, the typical Washington state home takes 49% of local median income. If I was launching my career today, I don't know if I'd choose Seattle, even though I love it here. Buying in the center of the country, from Texas to the Midwest and Appalachia, is vastly more affordable, even accepting the lower incomes that often come with it. But let's say leaving just isn't an option. Your industry is in that expensive metro. Your most important people are there. You've got 20% down, but that mortgage payment will just destroy your ability to spend and save. You still have options. Ever heard of co-investment? Co-investment platforms source money from investors to put up the other 80% to your 20%. It's not a mortgage, but you still have a monthly payment, just usually much lower. And why? Well, co-investors aren't giving you a loan. They're putting up money to split the home equity with you. To sweeten the deal, especially where home equity grows more slowly, part of your monthly payment goes to investor dividends. The other part covers platform fees. So, want to increase your ownership? Pay extra and gradually buy up more. Build up more than 20%, and you can withdraw funds within days and lower your share back to 20% if needed. A fraction of the refinancing headache. Co-investment is crucial for expensive markets. You may have 20% down, but still not qualify for a mortgage. Co-investment avoids mortgages entirely, using investor interest to bolster homeownership options. Like and subscribe for our next video exploring real estate's investment potential, where you can find out how many more years of retirement you might get by moving. Are you a co-investor interested in a data project? Reach out to Reimagine Economics on LinkedIn.